Hello, I'm Hans Lee from Livewire Markets and welcome to this feature interview. Our guest is Kaloo, Global Head of Equities and Head of Emerging Market Equities at Aberdeen. Kaloo has been in Aberdeen since 2000 and he has quite literally covered the world in that time. He's normally based in London, but we are delighted to see him in Sydney. Devon, great to see you.
Thank you.
Why don't we just start with the million-dollar big picture question? Is a global or a US-led recession your base case, or how do you view that particular subject?
So I think when you look at the US market and indeed the European and the UK market, there's been a significant raise in interest rates of anywhere between 400 to 500 basis points. And at the same time, over the last 5-10 years, there's been a significant increase in debt. It's really hard to envisage how higher rates don't lead to an economic slowdown if there is so much debt in the system. So yes, we think a US slowdown and a global developed market slowdown is in the offing.
Yeah, okay. Well, you've got the US economy going that way, but it's also been a standout year for mega cap technology stocks in the US. We talk about this bifurcation, right, between the US markets and the US economy. Do you see this outperformance continuing from where you stand?
So I think you're absolutely right. When you look at the US economic market performance, it's been fairly concentrated in these big tech theme names. And I suppose part of the problem is that when you're thinking about the US economy going forward, there's this slowdown, and as a result, some of these other companies are suffering. But I do think that the tailwind in terms of the tech stories is pretty strong. So it's going to be difficult to avoid them. But actually, I would say that in terms of investing in some of those tech themes, there are better opportunities outside of the US.
Okay, so investing outside the US, if those opportunities look better, I have to ask, we are in Sydney. How does the Australian market look as an opportunity in that broad developed market, that broad global sphere?
So I think from a developed market perspective, when people think about Australia, they think about some commodities first and foremost, and there's absolutely lots of commodity companies and extremely well-run commodity companies to invest in, from BHP to Rio Tinto. But there is, as you well know and your listeners will well know, there's a lot of smaller mid-cap names that you're able to play as well. From my perspective, looking at it from a global viewpoint, I would say that we probably think the commodity companies still, the big cap commodity companies still have a lot to offer, and they're well positioned, particularly for the transition story or the energy transition story. But there are obviously companies outside of that in Australia which potentially could look quite interesting as well, such as the banks, such as some of the healthcare companies. But again, for me, when I'm looking at Australia, I'm looking to find how we can get the best quality commodity names.
Yep, okay, interesting. Let's go then to that, if you like, that broader story. I'm sure you will know, and even our viewers and readers and listeners will know if you've ever read the Livewire website really over the last year. I mean, bond yields have been climbing. You've got crude oil near 10-month highs. We're starting to see some signs of loosening in the US labour market. And then in China, you've got the opposite problem where you've got signs of deflation, multiple reasons for concern in the property market. Let me ask you this. Do you think all this newfound pessimism is justified?
So I think that there's reasons to be concerned about the US because of the valuations. So as we said earlier on, we think that the US economy is likely to slow. There's been a delay in the impact of interest rates that we can talk about, but actually they will come through. Whereas in contrast, there's a lot of pessimism with the Chinese market, and we are less pessimistic with regard to the outlook for the property market, and certainly think that the Chinese authorities are going to get it under control, in which case there is better valuation opportunities in China.
Okay. Well, you refer there to the property market. What is your outlook for China, especially regarding not just property, but also those consumer names?
So I think when people talk about property crises, which is what they're currently talking about in China, you have two examples to draw on. The first is the Japanese example, where property prices went up a lot, households, corporates took on a lot of debt, and then when property prices turned, they paid down debt. And as they paid down debt, that impacted economic growth, and then that's meant that they paid down more debt, and you had this debt deflation or balance sheet recession. In contrast, if you look at the Asian crisis back in 97, 98, 99, what you had was that there were many companies which also focused on investing in property, but they did so in terms of financing via US dollar debt. So there's a mismatch between assets and liabilities. So when things rolled over, they had to pay back that dollar-denominated debt. That was a major problem. China is very different. China, first and foremost, the households don't have very much debt. So when you look at China as an example, the households probably have have had to pay something like a 50% down payment in terms of being able to get a mortgage. So they haven't had to take very large mortgages, so there's not a lot of debt. And similarly, the debt is funded domestically. It's not export or it's not dollar denominated. And the reason why that's all very relevant is that we think that therefore the slowdown in the property market in China is fairly containable, and it is just a matter of time before there's enough policy support to see that recover.
So you would then, I take it from what you're saying then, you don't think China will go down this Japanification route, right, the last decade, and you refer to the balance sheet recession and deflation. You don't think that it will be Japan 2.0?
I think that the government certainly has the wherewithal to be able to prevent that, and more importantly, the households have the balance sheets to prevent that. So no, I do not think we'll be going down the Japan balance sheet recession route.
Yeah, okay. But I think there's no doubt, though, that it's been a studded recovery for that economy. This COVID-19 reopening, which they had at the beginning of the year, everybody was talking great about it. It's kind of fallen flat. How does that studded recovery kind of weigh on your opportunities and your view of the global markets?
So I think as you have a slower US economy and potentially European economy going into 2024, 2025, I think that the opportunity is that China will start to recover and emerging markets will do better. So from a going forward perspective, we're talking about shifting more money into emerging markets versus developed markets. And the one point I'll just perhaps say on the China story is that we do expect, as the property market to stabilize, consumption to pick up again. And they have a lot of cash, right? So household savings are at record high levels, and that money will eventually be spent, which will support that economy. So when we think about going forward, I think it's easier to see the support for some of these emerging market countries like China than it is necessarily for some of these developed markets.
The other thing as well with emerging markets is that I think those assets and those share prices have had a very difficult time, really over the last decade on an aggregate level. Why is that, and do you think that's all about to change?
So I think there's two reasons for that. The first is the dollar, and the second is earnings. And on the dollar side, certainly over the last, effectively since 2011 onwards, we've seen a really strong dollar versus everything else. And one of our views is that as the US slows down and interest rates peak and start coming down, then there's going to be less support for the dollar. And that means that when you're making that call between EM and DM, then EM looks a bit more attractive relative to DM. And within DM, then you also look at some of the other areas outside of the US. But that dollar tailwind or headwind is a key determinant of whether you want to be allocating one way or the other. The second point, as I said, is with regard to that earnings story. And in terms of the earnings story, when you look at emerging markets in particular, there's key drivers we think that are multi-year, which should support a better earnings story. And the first is supply chains shifting. So we have, as a result of the US-China tensions, supply chains being moved away from China or moving into other countries. That's really positive for the underlying countries that are beneficiaries of that, so Mexico or Indonesia or India. The second is the huge tech cycle that we think is going to pick up, because again, when you think about tech as a hardware, as opposed to an e-commerce platform business, what you have is a lot of the stuff is made in emerging markets, so that should help drive as well. And the third is the energy transition story. Trillions and trillions of dollars are going to be spent in transitioning the world away to a more decarboned or less carbon future. And that requires stuff that's in emerging markets and indeed Australia in terms of commodities, but also wind turbines, solar power, energy, batteries, requires electric vehicles, all of that sort of stuff, which you can find an awful lot of exposure in emerging markets. So the first thing I'd say is at the beginning, you've got the dollar call to make, and the second is, are the earnings drivers going to be there? And I think in that regard, we're increasingly worried about the outlook for the US.
Now, I think that this has got to be, given your role, your global head of equities and head of emerging market equities, we can literally say that you do cover the world and the tens of thousands of listed companies that are available. Which sectors do you guys have an overweight positions in your various funds, and I guess why as well?
So we're believers in the tech story, right? And I suppose one of the first things here is that there's we think, a multi-year tech cycle coming through. That's driven by AI, which I think is well understood in terms of the opportunities there. That's driven by autonomous driving. That's driven by 5G and product upcycles. And of course, the whole shift in terms of digitalization. And the reason why that is really relevant is because it is a tech hardware story. When we looked at the last tech cycle, it was a platform e-commerce story. It didn't require a lot of hardware. but a lot of chips, both DRAMs and computing chips, a lot of servers, cables, connectors, all of that sort of stuff is made in emerging markets. And as a result, we think that's a big earnings driver. So we have quite a lot of exposure in that regard. The second thing is that I do think, certainly when you're looking at some of these areas, that the financials look pretty good. So you have seen, particularly in emerging markets, a lot of orthodox economic policies with regard to interest rates and balance sheets and the managing of that. And as a result of that, actually, the financials are in pretty good shape.
Yeah. Okay. Interesting. Well, you mentioned AI. I just have to ask: Does the fund hold Nvidia, and do you have a view on Nvidia, kind of obviously being that poster child of AI?
So no,
Yep.
we think it's looking a bit expensive now, and hence the reason why our preference is to invest in some of these emerging market names, such as Taiwan Semiconductor, such as Samsung Electronics, because they are well positioned, we think, for the recovery in tech and significantly cheaper.
Yeah, well, yes, that's of course that's very important. The price you pay is very important. Okay, so you're talking there about TSMC, Samsung, two of those great names in the emerging markets space, or I guess great in terms of size specifically. Where are you seeing some of your other best opportunities in emerging markets beyond tech?
So I think some of the interesting names that we look at today are things like Bank Rakyat or Rakyat Indonesia, so BRI, otherwise known. And it's a really good example of how orthodox economic policies in Indonesia have created a stable macro environment in terms of interest rates, in terms of debt cycles or credit cycles. And this is a company that's well positioned to benefit from that because they're doing a much better job of lending money without necessarily taking on significant risk. They're focused on SMEs and micro lending, and they're well positioned as financial services penetration increases in Indonesia, that we think there's a multi-year story there.
Yeah, okay, interesting. Well, so you've talked about BRI, you talk about TSMC, you talk about Samsung, Nvidia. I was interested in your viewers there, but I'd be willing just to hear from you, just to finish this up. Can you take us through the investment thesis for maybe a couple of high conviction stocks that you currently hold and the why?
Yeah, so we are substantial shareholders or holders of HDFC Bank, which is an Indian bank. And there's a number of reasons why we're pretty positive on the macro backdrop for India. So the first thing is that we've seen a significant rollout of digital identity, and that has meant that effectively everybody has an identity which can be used for banking. So it's suddenly opened up a huge market of unbanked to be banked. The second is that there's been huge reform in the tax take in India, so they broadened out, simplified it, and that means that the fiscal position improves, which means that the volatility that you've seen historically with regard to interest rates and deficits on the back of the fiscal position becomes less of an issue. And of course, there's been significant investment in infrastructure. But then you have an additional kicker when it comes to India, which is that they're one of the major beneficiaries of the US-China tensions. So a lot of companies are shifting to India to set up production, and of course, that's going to help overall. So you want then to be exposed to some of the broadest macro exposures that you can get, and a bank is a very good example of that. And HDFC Bank over the years has done a tremendous job of lending money through cycles without having the bust. It is relatively well positioned for the expected growth that we see in India. And just going back to its history, I do want to stress the point, it's done a tremendous job in terms of lending money and not having a significant bad debt issue, which is one of the crucial issues you need to look at when you look at banks.
Yeah, okay. Well, you're talking glowingly there about India. We were talking about China earlier. I now have to finish with this. What's the country weighting that you give to, say, how much weighting do you give to China and how much weighting do you give to India? And how much maybe do you see that changing over the next few years?
So we have an overweight in India and underweight in China, but the direction of travel in recent months has been to reduce India and increase China. So we think there's a great valuation opportunity. There are risks, obviously, in China, and it's still got to work its way through a property market. But we think a property market issue, but we do think that that's more than reflected in the price. Whereas in contrast, the Indian story is well understood, and prices look a bit more expensive there. So we would see us continuing to add a bit more to China as it rallies and potentially pair the India weight.
Yeah, absolutely interesting. Devin, Kaloo of Aberdeen, we really have been around the world. Thank you for joining Livewire. Good to see you.
Thank you very much.
And thank you for joining us for more of these great insights. You know where to go at livewiremarkets.com and, of course, our YouTube channel as well. Thanks for watching.